Welcome back, learner. Myself, Dr. Vinita Singh, Assistant Professor, Department of Commerce, RGSC, Banaras Hindu University, with the course Rudimentary Principle and Practices of Managerial Economics. Today, I will be starting with the new module, that is module number 8, lecture number 36, with the topic cost analysis. In today's topic, we are going to discuss two parts, that is concept of cost analysis and types of cost concept. Concept of cost analysis. Basically, what is cost? Why we do considered this particular phenomena an important element in business? Because every business decision is somewhere affected by the cost. That means cost of producing the goods and services. It is the cost which ultimately decide the profit of an organization. If the business able to manage its cost effectively, definitely the organization is able to earn a huge profit. So, basically cost analysis play a significant role in economics. It is really important to use the right technique for analyzing the cost, as it enters into every business decision. It is crucial to estimate cost and revenue of the organization for making important economic decision. Because in every organization, the basic objective is to produce the goods and the services and thereby to earn a profit. So, this cost and revenue need to be clearly understood by the organization, how they can effectively implement it for taking good economic decision. It acts as a tool in estimating and analyzing various alternatives in quantitative terms and taking better decision for the entity. In the absence of cost analysis, internal and external management may not be feasible. That means the management of the organization run around the cost, because everything involves cost. Each section, each department of the organizations involves some or the other type of the cost, and this cost ultimately leads to the overall cost of producing the commodity. So, effective management, whether at the internal level or at the external level, need to be done effectively by the organization. In the market, different products are jointly produced by an entity. So, it becomes very relevant to jointly allocate the cost of these commodity for pricing purpose. As we know that whenever we are producing the goods and services, it is not always we are producing a single commodity, rather than we are producing so many commodities at a time. So, the cost of producing a single unit, that is the per unit cost of producing the commodity, or the cost of one commodity with the other commodity, need to be specifically allocated. Then only we can decide the overall selling price of the product. So, it is important to identify the cost of a single commodity, because on that basis only the selling price is decided and the profit margin of the organization is as well decided. So, it is important to understand the various concept of cost, for which two basic components need to be understood. General cost estimation done by conventional accounting pattern is not appropriate for all managerial related concern and decision making. Different business issues and problems having different kinds of cost involved. That means costing does not means only a monetary terms. So, considering only the cost of producing the commodity, along with that there are so many costs all that cost need to be considered in order to actually identify the overall cost of the organization. Meaning of cost analysis. This cost analysis is basically made up of two words, cost and analysis. Cost means the expenses which the organization actually bear for producing the goods and the service. It is the cost definitely the organization has to bear. This cost means the cost of factors of production, because goods cannot be produced without factors of production, and all these factors of production need to be rewarded in the form of some remuneration, and that remuneration is the cost for the organization, such as wages to the laborer, capital, interest for the capital, rent for the land, so many costs. So, all these factors need to be rewarded, and from the point of the organization, these are cost. So, cost component need to be understood and strategy need to be made in order to reduce the cost. Analysis means identifying, observing the best alternative way of producing the commodity. There are various methods through which goods can be produced, and every method is different from the other method, and the cost involved in every method is also different. So, you have to choose the best method, you have to choose the best strategy for actually producing the goods, because every strategy is different from the other strategy. And if you choose some strategy which is costly enough, your cost of production will reach up and it will reduce the profit for the organization. So, together we can say that cost analysis means systematic breakdown of any process for a particular project, business operation, product for examining, evaluating and identifying the various costs associated with it, so as to understand its financial importance and return from such decision. So, cost analysis means a technique, a method, a strategy, a plan which need to be decided how an individual process or how an individual product need to be broken down into various subparts and costing should be evaluated, so that best possible strategy selected which will definitely reduce the cost of production, thereby increasing the profit for the organization. Cost analysis talks about a way of reducing the cost. Cost analysis refers to the comprehensive study of expenses, including fixed and variable cost, overhead and other financial outlay, to assess their impact on profitability and to identify areas for cost reduction or optimization. Basically, we know that there are various types of factors, fixed factors and variable factors. Depending upon there are various types of the cost. Each cost need to be identified, each cost need to be reduced so as to overall increase the optimization of the production and reduction of the cost overall. In short, we can say that cost analysis involves the study of various components of production and cost associated with it, such as factors of production, level of output, scale of operation, objectives and goals of an organization, market competitors, external factors in the economy, techniques adopted. Basically, cost is everywhere. It is in factors of production, it is the type of business you are considering, it is the types of technology, various external factors, the market. So every element has cost. So you have to choose the best possible combination or a strategy for producing the product so as to reduce the cost. As you can see a slide that basically representing the various concept of the cost. For actually understanding or analyzing the cost, you need to learn what are the various types of cost, because having a knowledge for the various types of cost, that will actually help you to identify the area and to cut the cost. So there are various types of cost concepts such as money cost, real cost, opportunity cost, variable cost, historical cost, replacement cost, incremental cost, fixed cost, short run cost, long run cost, sunk cost, shutdown cost, private cost, social cost, economic cost, abandonment cost, urgent cost, controllable cost, marginal cost, accounting cost, uncontrollable cost, postponable cost, and so many. There are still so many costs. So think about, there are various subheads. Each subheads I am going to discuss with you in the coming slide. Talking about the very first type of concept of cost, that is the money cost. Money cost is also known as nominal cost. Basically, money cost means the overall expenses incurred in producing the commodity is the money cost of that product, which basically means all the expenses incurred in producing the commodity, that is the money cost, or you can say total cost. These costs are wages, salary, transport, interest, raw material, depreciation, power, fuel, electricity, so many. That means just think about all those material required for producing the commodity efficiently, all that entered and become the part of money cost. For example, suppose if I need to actually produce pen, so producing cost of that pen is the money cost of that pen. For example, cost of producing the pen is 10 rupees. So 10 is the money cost. Money cost includes explicit cost, implicit cost, and a portion of normal profit. Explicit cost. Explicit cost are the cost which is paid by the organization to the outsider. That means it is the cost made to the external factors of production. These are explicit cost. For example, wages, interest, rent, these are explicit cost. Implicit cost are the cost that is paid by the entrepreneur for its own resources. If that resources would have been used outside, definitely that would have returned some reward. So it is the reward made to the entrepreneur own resources. Nominal profit, every cost of producing the commodity involves a portion of the normal profit to the entrepreneur. So money cost basically includes three things: explicit, implicit, and normal profit. Real cost. Real cost is the effort or sacrifices made by various members of the society for producing a commodity. That means it is the sacrifices or effort made by every factors in producing the commodity. For example, real cost for the laborer. Laborer give their service, give their time, give their effort in producing the commodity. So, all the sacrifice the labor is actually making in producing the commodity is the real cost for that labor. Opportunity cost. Opportunity cost is also known as alternative cost, transfer earning, transfer price. Opportunity cost can be explained as expected return from the second best use of resources which have been foregone due to scarcity of the resources. That means opportunity cost is the foregone cost. For example, suppose you have 5,000 rupees and with that 5,000 rupees you invest in a particular product A and that is giving you some benefit. So, with the same 5,000 you can also avail the product B, but you are unable to purchase B because of the limitation of the resources. So, this B is the opportunity cost. That means with the same money, the next best alternative that was available, which you are unable to purchase, which you are unable to buy due to because of the limitation of the resources, that is the opportunity cost. Fixed cost. Fixed cost, as its name itself means, that means the cost is fixed. Fixed costs are the cost which does not changes with the level of output. It remains constant as it is. If there is a production or there is no production, this fixed cost remain constant. So, we can say that fixed cost is irrespective to any level of output. For example, suppose the fixed cost of producing commodity A is 5,000 rupees. So, 1 unit 5,000, 0 unit 5,000, 2 units 5,000, so and so on till 100 units 5,000. That means whether you are producing the zero commodity or you are producing the unlimited commodity, this fixed cost will not going to change. And it is due to this feature of the fixed cost, the cost per unit reduces with every increase in production of the commodity. That means average fixed cost reduces with every increase in level of production. These fixed costs are also known as supplementary cost, overhead cost, indirect cost and general cost. Variable cost. Variable cost itself means variable which can variate. The variable costs are directly proportional with the level of production. Higher is the production, higher will be the variable cost. Lower will be the production, lower will be the variable cost. No production, no variable cost. That means this variable cost is directly proportional to the level of production. If you are increasing the production, variable cost increase. If you are reducing the production, variable cost reduce. If there is no production, no variable cost. This cost is also known as prime cost, direct cost or special cost. Short run and long run. Again, the time period is short run and long. So, whenever we are talking any cost related to the short run, then that is known as short run cost. And anything that is related with the long run, that is known as long run cost. In short run, there are two factors, that is the fixed and variable. And when there are two factors, so commodities are produced with the combination of fixed and the variable factors in short run. So if there are two factors, definitely there will be two costs. So in short run, there are fixed cost and variable cost. And what is fixed cost and what is variable cost? I discussed it already. So basically, short run cost means fixed cost and variable cost. Long run cost means the cost which basically belong to the period of long run, where all the factors have been converted into the variable factor and there is only one factor, that means there will be only one variable cost. So long run means variable cost. Accounting cost. Accounting cost means these costs are ascertained through profit and loss account of the firm is known as accounting cost. It is determined as per the principle and practices of accountancy. It includes explicit cost. Only monetary cost is considered under accounting cost. That is why it is less important for managerial decision making. Therefore, accounting costs involve cash payment that the firm makes to an outsider for their contribution in the production of goods and services. So, accounting cost means, accounting cost, the word is accounting. So, all those costs which can be recorded in the books of account, that is accounting cost. That is why it is denoted as profit and loss. So, all those costs which find a place in books of account, that is cost. And we already know that in books of account, only the monetary cost, only the monetary benefits, only the thing which can be converted into monetary value is recorded. So, that means accounting cost involve monetary cost. It means the explicit cost, the cost which is paid to the outsider. But for manager point of view, because manager needs all the information. Manager need monetary as well as non-monetary. But accounting cost talks about monetary. That is why for taking the managerial decision, accounting cost is considered less important. Economic cost. As I talked to you, accounting cost includes only the monetary cost, whereas economic cost include both monetary and non-monetary cost. It involves both implicit and explicit cost. That means for taking managerial decision for the firm, for the organization regarding any decision, it is the economic cost which need to be considered. So, economic cost basically means explicit cost, payment made to outsider plus implicit cost, imputed value of self-owned factors of production. Shutdown cost. It is the cost which the organization has to bear when the organization has to shut down its production process for temporary in short run, and they have to bear the cost equal to the fixed costs. So, when business is shutting down its business for temporary period and all the expenses which actually they bear, that is known as shutdown cost. So, we can say that there are two types of cost in the short run, fixed cost and the variable cost. Fixed cost remains constant, variable cost variate with the level of output. So, if you are stopping the business, that means there is no variable cost. So, which cost is left? Fixed cost. So, that means whether if you are closing your business for a temporary purpose, you have to bear the expenses equal to the fixed cost. And it is due to because of this nature, it is advised to the entrepreneur not to shut down its business for temporary if they are able to cover average variable cost. If they are able to cover average variable cost, they should continue with the production even at the loss. But if they are unable to cover the average variable cost, they are supposed to close down the business temporarily in the short run. The shutdown cost is nothing but the expenses made by the entrepreneur in the short run when they are actually closing its business for a temporary purpose. Abandonment cost. It is the cost which the firm has to bear while removing any permanent property or fixed asset from use. These may occur due to obsolescence or due to improvisation of the firm. Abandonment cost basically involves the problem for disposal of the asset. Abandonment cost, shutdown cost means you are closing the business and you have to bear the expenses. But in abandonment cost, you are not closing the business, rather you are closing some particular unit or some particular product totally from the production. That means it is the cost of disposing of the asset permanently from the organization. For example, suppose you have a machinery and now that machinery is not working properly. So you are completely disposing of that machinery from the organization because that machine involves a lot of maintenance cost. So it is advisable to dispose of, to remove the asset. So whatever is the cost actually bear by the organization for removing the asset from the organization, that is the abandonment cost for that particular asset. Replacement cost. Replacement cost basically refers to the price of the commodity which they need to pay for replacing the same commodity, and that is known as replacement cost. For example, you have a machinery and now that machinery is not of use, and the same machinery you want to purchase it again. You have purchased this machinery 5 years back, that costing you 1 lakh rupees. After 5 years, you want to purchase the same commodity and that is costing you a 2 lakh rupees. So how much extra money you must be needing to replace the same asset with the new asset, that is known as replacement cost. Historical cost. As we know that it is the original price of the product. Historical cost is nothing but the original price which we actually paid for buying the commodity and actually making it under use. And in the books of account, it is the historical cost which is recorded. For example, you have purchased a machinery of 50,000 rupees. So this 50,000 is the historical cost for that asset. And in the books of account, you are going to represent this asset only by this cost. Incremental cost. When a firm changes the form or level of its business activity, the cost involved in this is called incremental cost. For example, additional cost to be incurred for producing new brand of the product, changes in the distribution channel, installation of new machinery is called incremental cost. It appears to be similar to marginal cost, but it is not a marginal cost. Marginal cost refers to the cost on added unit of output. Incremental cost means increment. It is the cost which the organization has to bear whenever the organization is adding something new, adding some new product, adding some new machinery, adding some new venture. That means whenever you are increasing altogether a new venture, altogether a new product, so whatever the cost you bear, that is called incremental, because it is actually increasing your capacity area. And incremental cost is different from the marginal cost. Marginal cost means addition made. One more units of good is produced. I am talking one more units of good. Whereas incremental cost is considered when you are adding all together a new product. Sunk cost. Sunk costs are costs which cannot be altered in any way. Sunk costs are costs which have already been incurred. That means it is the cost which has already been incurred and it has been fixed and logged in that asset. For example, everyone at their home is having so many of fixed assets. You have purchased the fixed asset. The money has been blocked in that asset. So that money which has been blocked in that asset, it is the sunk cost. For example, you have a car, you have a bike, you have a scooty, you have a television, you have a refrigerator. All these are fixed asset and you have invested a lot of money in it. Once you have invested the money, you cannot increase or you cannot decrease the money. You cannot even dispose of the asset. You have to use that asset because this capital has been permanently sunk, blocked in that particular asset. So this is the sunk cost. For managerial decision, incremental cost is more important in comparison to the sunk cost. The sunk cost remains unchanged whatever may be the level of business activity. It is the incremental cost that is considered for taking economic decision and not the sunk cost. Social cost. It is the cost borne by the entire society directly or indirectly for producing the commodity, and it is nothing to do with the money cost. It is the sum of the private cost along with the external cost imposed on others through activity. So social cost is the overall cost that is bear by the society. That is why the name is social cost. It basically means the private cost which we are actually facing and the external cost imposed on other. For example, large amount of smoke through chimney are emitted in the atmosphere by the factories. The social cost borne by the community in the form of additional washing bill, medical bill and etc. Controllable and uncontrollable cost. Controllable costs are the cost which can be controlled by the manager. It is the cost through which you can increase the cost or through which you can reduce the cost. So it is totally in the hand and the control of the manager. That means these costs can be adjusted as per the need and want of the organization. Example of controllable cost basically include direct labor, direct supply, donation, training, bonuses, membership, due overhead, etc. So these costs are controllable. Uncontrollable costs are the costs which cannot be controlled. Manager cannot control this cost. Manager cannot easily adjust this cost as per the need and the want. So these costs cannot be controlled, but in the long run, it can be negotiated and can be controlled. But in the short run, it can never be controlled. You have to bear it at any cost. You cannot adjust this cost as per your need and want. For example, for uncontrollable costs basically include rent. You have to pay the rent whatsoever you are producing or not producing, you have to pay the rent. Utilities, share of administrative overhead and insurance fees. That means there are certain fixed expenses which you have to bear at any cost. You cannot control that cost. But there are the costs which you can increase or decrease, depend. That means you can postpone that cost. So that is what uncontrollable costs, postponable costs. So we can also discuss the urgent cost. Urgent costs are the cost which you cannot postpone. You have to bear that cost at any cost. And postponable costs are the costs which you can postpone for a time period. So this is all about for today's lecture. In today's lecture, we had talked about the most important concept, that is cost analysis. It is one of the most important because everything or every decision of the business depends upon cost. And the various types of the cost concept, because the knowledge of these cost concept actually help you to control the cost, to reduce the cost, to make a planning strategy, how you can manage effectively your cost decision of your business. Because a proper and effective cost analysis gives you a good cost output relationship. So thank you for today's session. I hope you have understood this particular concept. Meeting you again in the next section, discussing the same topic in a deeper manner. Thank you.